You are listening to the South America Brief. I'm Camila Perez, your virtual information influencer, guiding you through market data trends and stories from the vibrant economies of Latin and South America. Hello and welcome to this edition of South America Brief. I'm Camila Perez, your market intelligence guide to Latin America's economic pulse. Today, we're taking a deep dive into the latest outlook for Latin America and the Caribbean, an outlook shaped by both opportunities and persistent challenges. According to the freshly released Economic Survey of Latin America and the Caribbean 2025 by ECLAC, the region is entering 2025 and 2026 with growth projections that remain subdued. We're looking at an average real GDP growth of 2.2% for 2025 and 2.3% for 2026. While that's a modest upward revision from earlier estimates, thanks largely to stronger than expected performance in the first quarter, it still mirrors the stagnation seen in recent years. In other words, the structural hurdles holding back development remain very much in place. But beneath the regional averages lies a more complex picture. South America is set to outpace the regional mean in 2025 with growth of 2.7%, driven by recoveries in Argentina and Ecuador, accelerated momentum in Colombia, and steady expansion in Paraguay. Argentina's government under President Milei is pushing hard to stabilize the currency and attract investment, while Ecuador's President Noboa is rolling out bold energy and security reforms. Yet, most other South American economies are expected to slow in 2026, with the subregion's growth easing back to 2.4%. By contrast, Central America and Mexico face a sharper slowdown. Just 1.0% growth in 2025, nearly half the pace of the previous year. A key reason, weaker demand from the United States. Some economies like Guatemala, Panama, and the Dominican Republic will buck the trend, powered by vibrant service sectors, strong remittances, and robust domestic consumption. Still, the subregion remains structurally tied to the U.S. economy, making it vulnerable to external shocks. Mexico's President Sheinbaum is already negotiating to limit tariff exposure and protect the country's competitiveness. The Caribbean, excluding Guyana, is also losing steam. Growth is expected at 1.8% in 2025 and 1.7% in 2026, due to softer U.S. tourism demand, higher energy and transport costs, and continued exposure to climate-related disasters. Guyana, however, remains a standout performer thanks to booming investment in its hydrocarbon sector. The macroeconomic backdrop is far from ideal. We see slower private consumption, limited global trade momentum, and an uptick in external vulnerabilities. Geopolitical tensions, restrictive financial conditions, and the threat of commodity price volatility all loom large. ECLAC warns of widening current account deficits and growing reliance on external capital. One big external factor shaping the region's outlook is the wave of new U.S. tariffs. Since April 9th, most Latin American countries face a base tariff of 10%, with even higher rates for Guyana, Nicaragua, and Venezuela, though temporarily suspended. Mexico's separate 25% tariff, introduced in March, has been partially negotiated down, preserving its edge in supplying the U.S. market. The ripple effects of these measures could dampen growth not just in the region, but in key global markets like the U.S., China, and Europe, feeding back into Latin America through weaker trade, investment, and remittances. Country by country, the impacts vary. Mexico benefits from tariff exemptions in critical sectors. Venezuela, already under oil sanctions, could face severe revenue losses if secondary tariffs take full effect. Argentina and Brazil are focusing on negotiations rather than retaliation. Chile, Colombia, and Peru, shielded by free trade agreements, are better positioned, but still cautious. ECLAC's message is clear. The region must mobilize greater resources to escape the trap of low growth, high inequality, and limited social mobility. Three strategic imperatives stand out: improving domestic revenue through tax reform and better public spending, attracting external and private capital, by reforming international finance and expanding capital markets, and strengthening development banks to channel investment into key sectors. The recent Financing for Development conference in Seville underscored global commitment to sustainable development funding. For Latin America and the Caribbean, this is a window of opportunity to stabilize the macroeconomy, advance productive transformation, and build a more inclusive, sustainable, and resilient growth path. The bottom line, Latin America stands at a crossroads. Global headwinds are strong, but so is the potential for reinvention, if governments can combine a long-term vision with short-term agility. This will take not just economic policy, but political will and adaptability in a fast-changing world. Thank you for joining me on South America Brief. Until next time, I'm Camila Perez, bringing you the data, the context, and the insights that matter. Thanks for tuning in to the South America Brief. For more details, links, and further insights, check out the show notes. By the way, I am 100% AI generated. My voice was created with 11 Labs, and I'm here to bring you curated knowledge with a human touch. This podcast is powered by infobrokerworld, your partner for market intelligence and custom research on Latin America. Until next time, stay informed, stay curious. Hasta luego.